Jason England is with us, Managing Director and Portfolio Manager at Simplify. Christopher Barto, Investment Analyst, Fort Pitt Capital Group. Thank you both. Jason, what do you make of it? I mean, there are a lot of folks who think that you get a cut tomorrow because that's certainly what Fed funds futures are showing. Maybe a pause in December. But if Jay Powell is cutting, that Trump will leave it alone.
Yeah, I think obviously it's priced in. It's, when we got the strong September numbers when it comes to job inflation, there was that moment of market participants thinking this meeting would be a skip, but I think it's now priced in after we got the weak October jobs report that they're going to definitely cut by 25. I think they'll still do another 25 in December as well. I think they want to get it back down to a less restrictive level, somewhere around 4.5% is what we'd be by the end of the year. And then they kind of look and see next year with the data, and obviously now with the new administration, how they're going to proceed forward and try to get it to a more neutral level. And that's the key question, is where is that new neutral level and how far more do they need to cut to get to it? So I think right now it's a kind of on autopilot from here.
Yeah, and as you noted, core PCE at 2.7, unemployment 4.1%, that there seems to be a decent balance there. Christopher, what do you think?
Yeah, I mean, thank you for having me. I don't want to sit here and kind of sound like a yes man and agree with Jason, but I pretty much do agree with Jason for the most part. I mean, we do plan on having a 25 basis point cut tomorrow from the Federal Reserve, and they have been on this kind of streamlined path where I think we kind of need to see what the new Republican candidacy is going to implement in terms of their tax cuts, and if they continue with the Tax Cuts and Jobs Act. We have to kind of see how the 10-year reacts, and overnight we kind of saw the 10-year shoot up to around 4.44, and we have to see how these policies end up affecting inflation. So we think that 4.5 by the end of the year on the federal funds rate does sound relatively the most likely scenario. And then next year, it's really going to be dependent on how these policies start to pan out and the implications of them on inflation.
Yeah, understood. And, and it's not just the tool of cutting rates. There are other tools. They're running off the balance sheet. There are things that I think about the Fed that happen, right? They run off the balance sheet. You have had the government buying treasuries at one point. There's money printing. Jason, where do these things fit in? Because some people talk about them to supply and, do we have sort of too much money around and that's part of the problem?
Yeah, and I think that's is a good point to bring up about the balance sheet. They've always wanted, Yellen said it back in her term when they were running off the balance sheet the first time around. They want it to be like watching paint dry. It's just going to be in the background. But now you have an issue here where it's coming down, and they did reduce it. It's not coming down as much as it was, but still, at what point does the money supply get drawn out of the system? And then if you have this new administration that is inflationary, and I'm not saying it will be, but that's the inference that everybody thinks that it's going to be tariffs and tax cuts. So thus, more treasury issuance and deficit spending. And so what does that mean for the money supply? And do you need to see them maybe stop the balance sheet or at least maybe reduce it again and not roll off as much? I know they want to get to a treasury only balance sheet at some point. So does that mean they quit with the runoff in the treasuries and they just let mortgages run? It's a lot of uncertainty heading into next year now that we've got the new administration. At least that uncertainty is behind us. So it is something that will play into the Fed's thinking, is not just the Fed funds rate and how much more to lower that to a more neutral level, but also the balance sheet and how that tool is used going forward. And especially if they get to a point where they need to use QE again, if there is any kind of shocks down the road, how that is implemented when you have a new administration that seems to be on the surface a little bit against the Fed, or at least that's what we've seen with some of the rhetoric around President Trump.
And look, Christopher, we've had central banks doing a coordinated effort of cutting rates. I mean, we've seen that around the globe. A final quick thought, Christopher?
Yeah, no, I completely agree for the most part. And I think one of the more important things we kind of have to look at is, has policy necessarily been restrictive looking from a top-down approach, because earlier this year, the M2 supply of money has been hitting highs. And we also have a little bit of correlation between the equity markets hitting highs and multiples expanding on the back of this artificial intelligence theme. So looking at kind of the last 2 years, 3 years, and this rate hike cycle has it actually kind of tightened policy. And we could point to a few different areas in terms of consumer spending, which has held up greatly. But we also have to kind of take into account that the top kind of 20% of income earners in the United States also spend they're about 40% of the consumption and spending. So you kind of have this balance between restrictive policy and rates being where they are.
Jason England at Simplify, Christopher Barto of Fort Pitt Capital Group, thank you both for being with me here.